Welcome back to New Day Northwest. On March 10th, we saw the biggest U.S. bank failure since 2008. Silicon Valley Bank, a major lender to the tech industry, failed after fears of the bank's stability led to a run on the bank. A bank run occurs when a large number of depositors all withdraw their money at the same time, and the bank basically has no money left. In the past few weeks, we've seen a second bank fail, and others on the verge have only been saved by a huge infusion of cash from lenders. So we wanted to know what this means for people like you and me. Philip Bond, UW professor of finance and business economics, joins me now. Thank you so much for being here to help us kind of unpack what we're seeing in the national stage. First of all, why did this happen?
Okay, so I'd say this all started about a year ago when the Fed started to raise interest rates. So this happened pretty much a year ago. Rates then were pretty close to zero. Today they're about 4.5% for a short-term rate.
Okay.
And what this means is that banks, including Silicon Valley Bank and the other banks that have got into trouble, they'd made loans at the prevailing low rate of interest that was in operation a year ago. Now, the Fed since then has raised rates, so now the prevailing rate of interest would be much higher.
Right.
So a bank like Silicon Valley Bank now faces sort of two risks. One is that its depositors all say, we'd like to get a higher rate on our deposits.
Right.
And if that happens, the bank is in a mess because it's made loans at the old rate of interest, so it's getting in
less,
like 1 or 2% on its loans, but suddenly it would have to pay out considerably more on its own deposits.
Okay.
Or the other thing which can happen, which is what happened to Silicon Valley Bank, is the depositors can sort of skip the stage of saying, give us more money. They can just directly leave and go elsewhere. And when that happens, the bank has to sell some of its old loans. Okay, so it's funny to think about selling loans, but this happens all the time.
Right.
But the old loans are now not very attractive because they have that old low rate of interest.
Right.
So people aren't willing to pay very much for those old loans that carry that old rate of interest.
Right.
When if I lent money today, I could be getting more like 5, 6, 7, 8%.
So they're taking a huge loss on anything they sell.
They're taking a loss of about 10% on stuff they sell.
And so enough of that happens, bank fails.
Bank fails, exactly.
Will we see this happen again?
I mean, it's hard truthfully, it's hard to say. Because again, there are lots of banks, many of them probably are sitting on a 10% loss on a substantial portion of the loans they've made.
Okay.
So the good news is that banks have about a 10% capital buffer, so they should be able to cover this. But some of the more exposed banks, it unfortunately I think can happen to more banks yet.
So I think a lot of people focused, and the news and media included, on the headline. Silicon Valley Bank, they've been, home to, venture capitalism, people, investing. Had nothing to do with tech, though. It had everything to do with it being a small bank and where we're at with inflation, right?
I think the main connection with tech is that part of why people started moving their money out of Silicon Valley Bank in the first place was that because they were tech firms, they had seen their own funding dry up, and so they had to draw down their own bank accounts, regardless of whether they were concerned about the fundamentals of Silicon Valley Bank. Okay. So sort of money was flowing out of this bank, regardless of any worries, just because of the slight downturn in the tech cycle.
Got it. So there's the connection there. Should we be worried about our own banks? I mean, I know a lot of folks here are, with credit unions. Not everybody is with one of the big banks. I mean, I don't have $250,000 just sitting around. But does it still? I mean, should I still worry?
I don't think you should be worried. I think at this point, the government, I think, has taken pretty extensive steps to alleviate these sort of worries.
So we may not be worried about our banks, but should we be worried long term when we see something like this happen? Because you see a big bank failure, like, well, that's not my problem, those poor wealthy people, but it is a part of the economy as a whole right now, is it not?
It is, and there are certainly things you might worry about in terms of future effects on the economy. So we're talking very, very shortly before the Fed makes its interest announcement today. That's coming at 11 a.m. Seattle time. And the Fed now is in a mess, right? Because the Fed would like to raise rates to get a handle on inflation, but it would like to lower rates to help the banking sector. It's like it has one medicine for two diseases, and the medicine works very, very differently on the two diseases.
And this kind of happened a little bit, well, you know, during the pandemic. We were handing out money and just saying, here you go, but we didn't really have that money to give. And now are we seeing the effects of this?
I mean, I think you're asking now about, you know, what are the root causes of inflation?
Yes.
There's a lot of, I would say, disagreement on that, but certainly I think one of the causes of inflation has been government stimulus policies, yes.
Should we think about putting our money in other places right now if we do have investments or things of that nature?
I mean, again, I think the government has taken pretty extensive steps to alleviate those concerns. I think if you're worried that our alternatives, in particular, you know, if you're a significant sized business where you have significant funds, you probably should consider like one of these sweep accounts that puts your money in sort of various bank accounts simultaneously to benefit from the explicit 250K insurance in each individual bank. So it's a sweep account. They're widely available. Money market accounts are an alternative too.
Last question: long-term implications for U.S. banks on this.
So I think one we've sort of already touched on is the effect on inflation. I think there's some real chance that this drives more consolidation in the banking industry, like the big banks get bigger, which I think has pros and cons. You know, one thing which sort of might sound good for consumers, but is probably bad for banks, is that banks get into a price war for deposits now. I think there's some chance that happens.
Oh, well, there's that.
There's that.
Well, thank you so much for coming and taking the time to talk to us about this and understand a little bit better what we're seeing in the headlines right now. Thank you so much.
Okay, you're welcome. My pleasure.
We'll be checking with you soon, I'm sure. Well, coming